Traders, welcome back. In today's exciting video, we're going to be looking at the futures market, hence the title of the video, Futures Explained. We're going to combine that with Institutional Sunday, so we're going to have a look at a unique perspective on the week ahead. If you've been following me for a while, you'll already know you're not going to find anything like the sort of info I'm going to be showing you in this video anywhere on YouTube. You're going to be getting a unique investment banking stroke institutional perspective on the futures market. Let's get going. Okay, let's just get into it. So as you can see here, an incredible amount of information to cover. Just quickly take you through just to whet your appetite really, so you can see. You're going to be seeing stuff that no one shows, okay? Not only, obviously, we'll talk about my P&L, but before that, we're going to go into a really unique perspective, not only on the week, but also futures in general. We're going to talk about that on the first slide. So let's just do that. So the video is called Futures Explained, but as you can see, it's a different approach, an institutional approach. I've said it many times, all that technical analysis, random retail garbage, and I'm going to say openly, it doesn't work. No one's shown me any evidence it does. So let me show you a slightly different perspective on futures. So everyone comes into futures, would you agree? And they're all concerned about, oh, you know, how do futures work? How are they different to the spot market? And I will do a video on that, but it's not important, right? Too many people place too much focus on that. As to my first point, don't get bogged down, right, in all of that stuff. It doesn't matter what you're trading, crypto, you know, forex and spot, futures, options, it doesn't matter. They're all driven in the main by the same things, and that's what we're going to cover today. And that's really the whole point of the institutional approach to things. Don't worry about what isn't important right now. Worry about all that stuff later. It's such a small percentage of it. 99% is understanding the markets. In general, we will be focusing on the futures market because that is what I trade, but they're all driven by the same factors, okay? Too many people make too many distinctions and get bogged down in things. It's like your chart color. Does it really matter? Whether it's pink, black or blue, it doesn't matter. You need to know what factors are driving the market, and that's what we're going to look at today. So it's combined with the Institutional Sunday series. So just, you know, quick kind of make the point again. Do not get bogged down in the minutiae. Yes, spot and futures have a basis which can be positive or negative, and there are some subtle differences, and I can talk about that in detail in another video. But for now, understand the market, understand what drives the futures market, every market, and that's what you're going to see in this video. So let's have a look actually at last week. Like I said, I want to combine it with my usual Institutional Sunday. Last week, the market was up. And again, I talk about the S&P, doesn't matter what market it is, okay? It could be any market. In general, the market was bullish last week, right? That will have a spillover effect in all asset classes, forex, crypto, bonds, commodities, and equities. And you know, equity being the S&P being one of the most popular markets in the world, it's the best lens to look at from the basically US perspective. So we're going to have a look at week in review, manufacturing, jobs report. We're going to break down the jobs report very briefly, and yeah, basically just look at what drove the futures market last week. So as you know, I like to look at things slightly bigger. Quick summary, as I always do, and obviously shout out to my previous employer, Barclays Investment Bank, one of the biggest investment banks in the world and one of the best in my opinion. It's where I learned everything from that you're going to see in this video, and obviously a few prop firms that I worked at, but this is what really gave me an amazing grounding. So let's crack on. Monday, Tuesday, Wednesday, Thursday, Friday, right? Are you doing this at the end of every week? Are you reviewing your week? If you're not, you're in big trouble, okay? You've got to start thinking of things like this. If your educator isn't asking you to review things in this manner, you're going down a black hole. So let's do that together. Monday, there wasn't much data of note. There was pending home sales. but really isn't a big factor in the market at the moment. Tuesday there was really nothing. Wednesday we had a manufacturing number, which was very, very important, and I'm going to talk about that in a second. Thursday, no data of note, and then jobs report, right? One of the most important pieces of information every single month released out of the US, has an impact on every market. Forex, crypto, equities, commodities, bonds, everything under the sun is affected by this. So you need to know about it, at least to an extent. So that's what we're going to do. We're going to quickly have a look at what was driving the market last week, why we ended up slightly up. We actually had 3 all-time high attempts and successes last week, but we kind of ended up kind of rotational, not really going anywhere, but generally bullish. So let's just break that down in terms of what actually came out last week and what was driving the market. I talked about pending home sales, but on Monday, market just shrugged it off, right? We had a pretty solid start to the week, a firm start to the week. Tuesday, I believe we did pull back. Let's have a look. There you go. Slight pullback. And I believe we would have pulled back even more, going into the jobs report number as a sort of risk off. People selling assets, selling things down, taking some risk off the table. Are you thinking about these things? If you're not, look, it's not a bad thing. I'm just saying, start to think about how the week might shape up for you, and regardless of what you're trading. So coming in towards the latter part of the week, that's what was expected, but manufacturing threw a spanner in the works, right? A lot of people were trying to short the market ahead of this jobs number just as a risk off play, really. And manufacturing came in very strong, 59.9, you can see that. And even though we ended quite flat on Wednesday, that was quite a bullish day, because I believe the market was trying to sell off ahead of what was expected to be a very strong jobs number, and actually that gave the market a lot of support going into the jobs number, and we didn't really get any sell-off going into the number. So why was that? Well, let's quickly break down manufacturing. Very interesting. We saw the headline was 59.9, so you can see that here, 59.9 versus an expectation of 58.5. And like I said, I promised you a unique perspective. You're not going to see this anywhere on any YouTube video. I'm actually going to break down the manufacturing number for you into its component pieces. So survey gets sent out to purchasing managers, hence the PMI. They send back their responses about whether they're bullish or bearish on certain things according to what they're seeing on the factory floor. So, it's one of the most leading indicators you're going to get. 59.9, but what was the breakdown? Well, new orders, demand from consumers for manufacturing goods, or from purchasers, people, big companies that are purchasing, making manufacturing orders, solid, very, very high, up 2%. Production, i.e. supply, pretty solid as well. Employment slightly lower, but we're going to see that, and we saw that in the jobs report. It was off, so contracting slightly. But really, this is where the market's focus was, I believe. So the market was looking at that new orders number, and actually I'm going to go one step further and break that down for you further. So just remember that the new orders number was the driver behind this. So demand was incredibly strong in this manufacturing. I think it caught the market by a little bit of surprise. You can see here demand continues to outstrip supply. So we see that there, right? 66.7, we just talked about it. And then 60 was supply, production number, demand outstripping supply, which has two impacts. So it has an inflationary impact, and we saw that in a big prices number. You see that 79.4, a huge prices component. This is important. Obviously, Federal Reserve will be looking at this. What have the Federal Reserve said? We're going to be pegging our tapering decision later this year on inflation and employment, right? They expect inflation to pair off. Right now it isn't. So obviously that in itself is a slight negative in terms of, if you're expecting a delay in any sort of hawkish perspective or kind of tapering going on, you know, relaxation of the loose policy that we had, then obviously that's not good. So the market probably was not happy about that. But having said that, demand very, very strong, and as a headline number, I think the market liked this number. I think ultimately, to summarize the number, the biggest thing for this is we basically continue. So if you look at the pandemic started around here March, look at where we are right now, right? And the composite is 59.9, so somewhere in here. That level is well above the pre-pandemic level, and I think ultimately that's why the market loved this number so much. You know, no matter what way you look at it, if you strip out demand, supply, look at the inflationary number, which is the one kind of negative from it, the positive outweighs that in the fact that manufacturing demand continues to be very strong, and that's obviously good for GDP, and we are above pre-pandemic level. So ultimately, market took it to be very positive, which lends support, right? So instead of having what I believe would have been a fairly decent sell-off before a potential rally going into Friday, it supported the market essentially. So the market liked that number. And then just finally, before we cap off basically, because I think the only other number the market was looking at, and as we all know, was the employment number, which you see there. So let's have a look at that basically. Let's break that number down, as I always do. So the number came in very weak, didn't it? So a bit of back and forward here. 235,000 versus 720,000 new non-farm payrolls jobs added. So 500,000 underestimate. So on the face of it, a very negative number. We see that here, right? 235,000 versus 720,000. Right, now look at this number. 1053, right? 1,053,000. That was, I believe, what people who don't understand the market wouldn't have been looking at. So what actually happened, I think, is several things. So firstly, yes, the headline number undoubtedly was very weak, right? 235,000, you can see it there. No denying, the number was very, very weak, right? But overall, generally, it's kind of a blip, right? So we have been rising up. It's just a blip. Firstly, that's number one, which I think the market was like, well, it's not a trend. You know, it's not like we've been slowly declining continuously. It's a blip. Let's see what the next number is. So I think that was kind of the market's first reason for not sustaining a sell-off. We did see a sell-off initially on the number. The unemployment rate actually did continue to tick down at 5.2, but then comes back to the thing I mentioned, previous months revised up. Okay, so let's actually have a look at that. Previous months being revised up, you can see it here. So there you go. Got pushed up. The previous 2 months got revised up, I believe by around 200,000 cumulative effect it was. And let's have a look at what other things the market took positively. So you can see, even though the headline number was so negative, there are actually many positive things the market took out of it. So the other thing I want to talk about, and the final thing, is it was actually driven by supply rather than demand. So what I mean by that is that if you look at the number of openings, it's at a record high. Okay, there's plenty of supply. It's on the issue is basically that there's just more jobs than people are willing to take. Okay, so that's not such a bad thing, is it? It's better than how I've talked about when we come out of previous recessions, right? Where you've actually had not enough jobs, too many people chasing jobs. This time it's more jobs chasing people. And actually it's at a record high, the number of jobs chasing people. 1.7 million more job openings than the number of people unemployed. Okay, so that's a record high. So essentially, people are not feeling confident about going back to work, and we've seen that in the labour participation rate. This is all very positive because all it takes is some small factors to change, and people will start feeling confident, and the jobs are waiting there. They're ready for them. So I think the market took that quite positively, and let's actually look at some data that backs that up, right? So if we look here at the labour participation rate, we can see it's still off. Labour participation rate is kind of the number of people that are ready and willing to go back to work. So we can see that fell off. Obviously, not many people wanted to go back to work when initially the pandemic happened. And can you see it's still off pre-pandemic levels? So basically what's happening, you can see it in the data, what I said. There's a lot of jobs out there, but not many people are wanting to go and actually take them. And we're seeing that here. The participation rate is off. And here we can see, obviously, the number of jobs, as I already showed in the other graph, is at a record high. So, firms are struggling to find the right people. People don't really want to go back to work just yet. Why is that? Well, here we have one of the most significant reasons. I think most possible reasons, potential factors could be COVID cases. I've talked about in previous Institutional Sundays. Can you see the number of COVID cases rising again? We've talked about it. It started to level off last week, but it's kind of jumped now. Seems to be jumping again. So around 180,000. We spoke about this number previously. So can you see consumer confidence is coming off now? So we're seeing that as well in some of the lower level data, and consumer confidence is coming off. People are worried about COVID. They're happy to kind of stay on unemployment benefits. So a couple of things to note here. If this starts to turn around, which we've talked about already, that should get people wanting to go back out into work. Participation rate should go up. That should help the payroll rate go up. Can you see why the market was thinking, all right, it's a one-off, maybe these are unique circumstances and these factors will turn around very quickly. So yeah, you got to remember there are these unique factors in play. And then one final thing to note is there's a lot of kind of news coming out with a lot of states in the US now saying that they won't be renewing the COVID, I don't know what they're called, they're like COVID emergency claims, where people can get a little boost on their unemployment claims because of COVID. They won't be renewing those after September. So as those come to expire, I think this month, people are not going to have as much incentive to stay on unemployment benefits, so that may get them back to work. So those factors as well. So you can see why the market actually took it as quite, wouldn't say amazing number, but nowhere near as negative as the headline suggested it. So hopefully that was useful for you. Let's just wrap up now very quickly with looking ahead to the week coming up. So honestly, can't see anything. Monday is Labor Day, so that will be a day off. So a short week. Tuesday, nothing. Wednesday, nothing. Thursday, can't see anything. And Friday, honestly, I don't think there's anything this week. So actually, pretty much a non-event calendar. Do I think the market will be flat? No. I think the market will be digesting some of that information I've just shown you in the payrolls report, and I think they will continue to take that positively. So I'm fairly bullish on the week ahead. Let's just have a quick look at something in general, because there is no data this week. Let's have a look at what happens to the market after Labor Day, just very, very briefly. This unemployment number, right? So if we think about the number and what does it actually mean? Okay, so we've talked about the break number. What does it mean in terms of how the market is kind of expecting direction in the future? And that's what matters. What they'll be thinking about is, what's the FOMC thinking? The FOMC will be looking at that number, and they may potentially now push tapering or easing of their monetary policy, loose monetary policy. They might be looking at pushing tapering back, right? Potentially, right? So doubt that it's something they might talk about in September, but it's definitely not something they'll be announcing in September. But because of that, there's likely to be increased volatility, right? So if we actually look at historical volatility, going back 20 years, the VIX index, which I'll talk about in another video, but essentially it's a measure of volatility. If we look at that kind of June to August, right, we do tend to have lower volatility just because summer periods, people are on holiday and, you know, various factors, but that being the main one. People will come back post-holiday, and now we've got this new kind of taper timeline uncertainty with this unemployment number that's just obviously thrown a curveball. So likely, I think we'll see some higher volatility going towards the rest of the year. Do I think that's going to be negative? Not necessarily, because if we look at the average gains, so you can see it here. When the stock market is up double digits coming into Labor Day, which is this weekend, gains over the remainder of the year on average have been quite strong. So potentially there is, you know, up to another 8, 9, 10%. We're up 20% so far year to date. Could see another 8 to 10%. We may not, I don't know. September obviously does tend to be seasonally very weak, as we've talked about many times, but that's what I'm thinking this week. So 3 things to summarize. Potentially a supported market this week. Lack of data. We just come off what I think was fairly solid. Not headline number, but underlying factors as to the reason why the number was weak. So that could be supportive. Lack of data we talked about. Talked about potential high volatility going into the rest of the year after Labor Day, and generally if you look at the averages over the last sort of, I think it's 20 years, right? So 20 years this data has been pulled out of. You generally tend to get quite a positive end to the year. So we'll have to see how that turns out based on what happens. But certainly probably no surprises likely to be ahead this week. And then just finally, let's have a look at last week's performance. All fully verified. We'll show you that on the live account. Obviously, Monday was a bank holiday in the UK, so it didn't trade. So nothing on Monday. Tuesday, just over $1,000. Wednesday was about 600, I think, and then Thursday just under 1,000, and then Friday about 3K. So I ended up last week $6,000 cash. Okay, actual cash in my bank account. Let's have a very quick look at that, and I'll also show you how you can approach markets using Orderflow, the same things I do. I'm going to quickly show you how you can do that as well. Let's get onto the charts. Okay, here we are on my live charts. This is a footprint, Orderflow, real buyers and sellers, which I'll show you in just a moment how you can get your hands on. Very, very straightforward. Before we do that, let me show you something that, let's be honest, no one shows this stuff. Kind of adds credibility to what I'm telling you. When I tell you that technical analysis is a load of garbage, where's the evidence it isn't? No one's showing me anything like this. So, you know, I like to back it up. If I'm going to be controversial, it's good to back it up, right? So here you can see 2,975 on Friday. Traded the market long ahead of the payrolls number. Took a little bit of heat, but ultimately had a very good day, as you can see. And actually going to go one step further. So let me actually show you, my trade activity log. So you can see my P&L over the last 7 days. So here you can see, okay, full transparency, 7 days, 5,887.50 on my live account, same account, 5,887.50, okay, same as what I just showed you on the slide. Drawdown 1,400, long trades 3,737, short trades 2,150. Who's going to show you this stuff? No one. Doesn't exist. Okay, but happy to do that because it's important to me that I show you that. And just finally, you can see here what I use to actually trade footprint chart. How can you get access to this? Got a brand new webinar, amazing webinar, right? Got to check it out. The link, I'll put it here, www.g7fxfreetraining.com. You can also head over to my Instagram at NVForex, one of the fastest growing institutional trading channels that you'll see, cover all markets really. And just finally, if you like this video, hit the like and the subscribe button. Any questions, let me know in the comments. Hopefully that was useful for you. Love putting it together as always. Have a brilliant week.